Welcome back. It's Friday, Finance Fridays, and I'm your host, Anthony with InTouch Mortgage Solutions. And this week, we're going to unpack the headline inflation print that came in unexpectedly lower for the month of September. What is the data telling us? What does that data mean for the Bank of Canada? It's meeting next week on October 25th. They're going to be making their next rate announcement. Will they increase rates? Will they hold things steady? It is yet to be determined, but we're also going to unpack some of those business surveys, those consumer sentiment surveys on those expectations by consumers as we round out 2023. Now remember, the Bank of Canada will be meeting on the 25th, and the final announcement or the final rate decision for 2023 is going to be in December. And obviously the Bank of Canada, many economists are predicting that the Bank of Canada may decide to hold on to policy rates this month and wait to see exactly if they've done enough to tackle inflation. Now, obviously, inflation is still relatively high. For the larger part of the year, it has been trending upwards. It has come down a little bit from its highs just last year, but obviously with base year effects playing in, many economists did not expect the inflation print to come in at 3.8%. So as inflation dropped unexpectedly in September, that did come in at 3.8% compared to 4% just last month. Now, for many economists, this eases the concerns about the Bank of Canada having to raise interest rates next week. Interest rates and falling gasoline prices played a role in this major change. Now, obviously, durable goods have come down a little bit, so have some of the grocery items. They've come down significantly, but not enough for many Canadians that are finding it challenging. So we're still seeing this persistent inflation, but it is better than some of the double-digit prints that we saw coming out earlier this year. So as the financial markets have lowered their expectations on a rate hike, it's suggesting that potentially the Bank of Canada doesn't need to make any immediate changes. Now, some are saying that the Bank of Canada is done for the rest of the year. Some are saying that the Bank of Canada may hold for October. Obviously, the sentiment is everywhere depending on what data points you're taking, what type of data you're torturing. So this is very, very important to understand that as we see core inflation, medium, trim, and common basically coming down, so those are items that's stripping away things like food and energy. Well, they're obviously trending this month, so for the previous month, September, in the right direction. Obviously, over the last few months, those have gone up. So this was a major sore spot potentially for the Bank of Canada. But with this recent data, maybe it may lean them in the direction to hit that pause button just for the month of October. Now, with that being said, we have to look on the business side as companies expect slower sales growth. With cost and prices moderating, many believe it will take over 3 years to reach the Bank of Canada's 2% inflation target. Now, this is a problem as business expectations, if they think that it's going to take longer to get to 2%, some projecting 2025, well, this could be a problem for the Bank of Canada because they want to basically corral expectations in businesses and consumers that inflation is going to be taken care of and that the Bank of Canada is doing the job properly. And if they see that this is maybe not the case, well, it could lead them to maybe flex their muscles a little bit harder and show the market that, hey, they mean business and they may have to increase policy rate. And that is because in this business survey, a lot of the businesses are obviously seeing abnormal activity with the supply chains, with wages, with costs. And if these wages and costs and the cost for their items, whatever they're selling, or the services that they're providing, the wages that they have to pay their individuals goes up, well, that cost has to get transferred somewhere. The businesses that might be working on razor-thin margins may not be able to absorb those higher costs and not pass it on to the consumer. They may be required to pass it on to the consumer. And according to the data, that is the case. And that's not what the Bank of Canada wants to see happening. And you also have to take into consideration all the business loans, the Canadian Emergency Business Account. A lot of businesses that had taken on some of these loans are going to be coming due in January in the new year. And with higher interest rate costs, the potential that these businesses are struggling, they may have some difficulties covering those loans. Obviously, interest rates impact businesses and consumers alike, as it does limit their ability to go out there and get financing, especially if they want to expand their business, research and development, hire new people. Higher interest rates obviously impact their sentiment just as much as it does the consumer. Now, speaking of consumers, consumer expectation in the survey for inflation still remain high, influenced by, daily expenses, the cost of living, the higher rents, the higher mortgages, the higher food prices. Many expect higher interest rates to be a leading concern about the cost of living. Households are cutting spending and increasing savings due to these rate hikes. And this is changing the sentiment amongst consumers. Now, despite this, consumers see the labor market as healthy, although there are signs of it cooling. Overall, consumer sentiment is cautious due to concerns about inflation, interest rates, living costs, and the potential for a hard or soft landing when it comes to this recession that many economists have predicted. Now, obviously, as the consumer sentiment changes, if the expectation for inflation remains elevated, and if consumers believe that inflation is going to be around for much longer, these higher for longer interest rates obviously playing into the equation, but if inflation remains elevated, that could lead many consumers to take on the ideology that I better buy this item, these bigger ticket items like a car or finance appliances today because they're going to be more expensive tomorrow. And this is something that the Bank of Canada really doesn't like.
And if you look at inflation expectations, near-term inflation expectations are high, and there's a risk the longer they stay high, that starts to bleed into higher long-term inflation expectations, and then high inflation becomes embedded, and we can't let that happen.
But it does have to take into consideration that many Canadians are changing their spending patterns. They're saving a little bit more. They're not spending in specific markets as they were just a few short months and years ago. So the overall economy is turning over, as it does take many months for these higher interest rates to play out. We've talked about it on the channel before, the lag. It takes time for interest rates to be felt by the economy. And we've talked about that in June and July, there was 2 increases to the Bank of Canada policy, bringing it to 5%, the highest it's been since 2001. And because of the succession, the pace at which the Bank of Canada did it, well, the outcome right now is still uncertain. If they've over-tightened, if they've not done enough, but obviously they may take this opportunity with this data to really dissect and say, hey, maybe with the economy slowing down, the real estate market in peril, obviously more inventory, less buyers, higher interest rates, those bond yields we've talked about on the channel before, as these continued higher costs play out to consumers who are renewing their mortgages into higher rates, changing the pattern by which Canadians are willing to spend their money, especially if things are getting expensive, they're living paycheck to paycheck, there's just not all that money left over. And I believe the Bank of Canada pretty much has the average Canadian where they want them, in that mindset where we don't know, tomorrow's uncertain, let's maybe not spend today what we can save, and then hopefully things will change in the future. And obviously this has many people up in arms, many economists saying, hey, the Bank of Canada may not raise, the Bank of Canada is done. And obviously we will look at all that, especially on October 25th when the Bank of Canada makes the rate announcement. And if you want to stay up to date with our thoughts and what happens with the Bank of Canada, make sure you're subscribed to the channel, hit that notification bell, and obviously leave a comment in the comment section below. But before we end off, I just want to sort of do a recap right now. Obviously, with all the business sentiment, the consumer sentiment, obviously CPI coming in lower than expected, which is a huge win, at least in my opinion, the way I see it, even though yes, the cost of living is still high. A lot of these items are still more expensive than they were, but it is something that is pointing the Bank of Canada, will point the Bank of Canada potentially to hit that pause button, at least in my opinion, for October. What happens in December is anybody's guess. You let us know in the comment sections below. But remember, as the data rolls out, so does the percentages. So does the probability that the Bank of Canada will have to make a move, especially if we compare it to what's happening in the US. Here in Canada, US is on a different path than Canada, especially when we look at highly leveraged households, how debt is playing into the economy, how those mortgages are resetting much more quickly, how many economists are predicting Q1 and Q2, which is basically 2024, the first 2 quarters, that are going to be near zero growth. If we see near zero growth with an elevated number of new to Canada individuals at 1.2 million, and we look at those 65,000 jobs that were created just over the last little while, especially I think last month, a lot of those jobs were part-time jobs. Those jobs were returning teachers that are going back to work. And are there going to be enough jobs for these individuals, will that mean that if we don't have enough jobs for all these individuals, that unemployment will steadily increase? And what will that do to the Bank of Canada sentiment if they're looking at all these data points? So obviously a lot to really consider, but we want to hear from your viewers. What do you think is going to happen? Do you think the Bank of Canada will actually hit that pause button next week? Let us know in the comment sections below. Don't forget to subscribe to the channel, hit that notification bell, leave us a comment, and share the video if you learned something interesting on this week's episode. But we'll leave the video here, wishing everyone a wonderful Friday and an even better weekend ahead, and we'll see you next week.